Understanding stock options can be tricky, but the way I describe stock options to someone who is new to trading options is with real estate. Options are a contract, plain and simple. So let's say you have a $300,000 house and you think that it might be time to sell because the market might be topping out in your neighborhood. Your neighbor thinks that your neighborhood is going to keep going up and wouldn't mind buying your house to have as a rental. So you make a deal with him. If he pays you $1,000, you'll sign a contract to give him the option to buy your house in 1 year for $315,000. That is an option in terms of real estate. But let's add some terms that options traders use to describe the contract. First of all, there's the underlying asset, which is your house. See, at first, the trade is not about the house, but the contract that provides the option to buy the house. And the fee that comes in exchange for the contract, the $1,000, is called the premium. Then there is the expiration date, 1 year from now. Finally, $315,000 is what options traders call the strike price. Those are a few of the basic terms that options traders work with when describing options. Continuing with our scenario, after a year, if the house is worth less than $315,000, you get to keep the house and the $1,000. If the house is worth more than $315,000, your neighbor will exercise the option to buy the house because the house is worth more than $315,000. That doesn't mean that he has made money, because the break-even point is actually $316,000 because he already paid you $1,000 for the option to buy your house. Overall, you're walking away with $316,000. This particular contract is a call because it is the option to buy. If the option is to sell, it is a put. So how would a put work in this scenario? Instead of thinking the housing market may level off, you think the housing market may decline and your house be worth less in a year. Meanwhile, your neighbor sees the market holding steady or climbing. Then he may want to sell you a contract, a put, for $1,000 that gives you the right to sell your house to him for $290,000 in a year. If the house is worth less than $290,000, you exercise the option to sell your house for $290,000. You may have lost some equity in the house, but you are still ahead of the market in relative terms compared to your neighborhood. If your house is worth more than $290,000, you are out $1,000, but the market hasn't collapsed and you still own your house. Now substitute Microsoft or any other optionable equity for your house and you now understand the very basics of stock options.